Hey everyone, welcome back to Corporate Decoder, the place where we look under the hood of big companies and tell you what is really going on. And today we're going to talk about Blackstone Inc. and a report they put out that basically tells us they're borrowing a lot of money, and probably for good reason. Before we dive in, if you like deciphering this kind of corporate jargon into plain English, hit that subscribe button, and if you want to chat about these findings with fellow finance fans, join our Discord server. The link is in the description below. So Blackstone Inc., a name you've probably heard, they're a massive investment firm. Think of them as a giant money manager that invests in pretty much everything, from real estate to companies themselves. Today, we're looking at a report they filed on the 28th of October 2025 that talks about them raising a huge amount of cash through selling something called senior notes. Now, the actual entity borrowing the money isn't Blackstone Inc. directly, but one of its indirect subsidiaries called Blackstone Reg Finance Company, LLC. They're essentially selling off promises to pay back borrowed money, and they've decided to do this in a big way. We're talking about a public offering of $1,200 million in total. Yes, that is 12 zeros. Specifically, they're selling $600 million worth of notes that they'll pay back in 2030 with a fixed interest rate of 4.300%. Think of this like taking out a big loan that you have to repay over several years, and you are promising to pay a specific amount of interest along the way. And then another $600 million worth of notes that are due to be repaid in 2036 with a slightly higher interest rate of 4.950%. This longer term debt means they're securing funds for a longer period. Now here is a crucial part for anyone looking to lend Blackstone money. These notes aren't just backed by the borrowing subsidiary. Blackstone Inc. itself, along with a bunch of its other related companies, are giving a full and unconditional guarantee. This means if the borrowing company can't pay, the parent companies are on the hook. It shows a lot of confidence from Blackstone in their own ability to manage this debt. It's like saying, if one of my kids can't pay their rent, I will. So what are they going to do with all this borrowed money? The report says general corporate purposes. This is a pretty standard phrase, but it basically means they have flexibility. They could use it to fund new investments, pay off other existing debts, or just keep it as cash on hand for whatever opportunities or challenges come their way. Given how Blackstone operates, it is likely they have strategic plans for this capital, probably to deploy it into new income, generating assets or strategies. This offering was made under a special type of filing with the Securities and Exchange Commission called a shelf registration statement. This is a way for companies to pre-register to sell securities like these notes over a period of time. It means they had a lot of this ready to go. It was filed back in December of 2024, so this isn't a sudden decision, but rather the execution of a pre-planned financing strategy. Interestingly, this whole announcement was made via a press release, and that press release is attached to this filing as an exhibit. This is essentially how they officially confirm and disseminate this important financial news to the public and investors. Blackstone's main stock is traded on the New York Stock Exchange under the ticker symbol BX, and the report is signed off by Victoria Portnoy, who holds the title of Managing Director Assistant Secretary. This is a person authorized to officially act on behalf of Blackstone Inc. for these filings. Now, let's talk about what all this really means. Blackstone is essentially taking advantage of current market conditions to borrow a substantial amount of money. The interest rates, while not incredibly low, are fixed for a firm like Blackstone, which aims to make much higher returns on its investments than the interest it pays on its debt. This is a common and often profitable strategy. They're essentially saying, we expect to earn more by investing this money than it costs us to borrow it. The fact that they secured these funds with a parental guarantee is a strong signal of their financial health and their commitment to honouring these obligations. The dual maturity dates, 2030 and 2036, suggest a well thought out capital structure. They're balancing shorter term borrowing needs with longer term funding for their ongoing operations and investment horizons. This isn't just about getting cash, it is about strategic financial management. One of the key risks here, as always with debt, is market uncertainty. While Blackstone is a very sophisticated player, the economic landscape can change. If their investments don't perform as expected, or if interest rates were to skyrocket when they need to refinance in the future, they could face challenges. However, their diversified business model and track record generally provide a buffer against these risks. In conclusion, this filing signals that Blackstone is actively managing its capital, looking for opportunities, and is confident in its ability to generate returns sufficient to cover its borrowing costs. It's a move that suggests continued growth and investment, reinforced by the strong backing of the parent company. They are leveraging their scale and reputation to secure significant funding for future ventures. What is your take on Blackstone's borrowing strategy? Does it signal more aggressive growth or just standard financial maneuvering? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more corporate insights. And don't forget to join our Discord community for more discussions. Thanks for watching, and we'll see you in the next one.